Setting up a VCC. Learn about its tax implications. Be part of a world-class financial hub where you can seek early-stage funding opportunities while enjoying a robust IP protection and legal system, as well as an attractive tax framework when you set up a VCC in Singapore. What is a variable capital company, VCC? A VCC is a corporate structure for investment funds constituted under the Variable Capital Companies Act. You could put your VCC to use as a single standalone fund or an umbrella fund with two or more sub-funds, each holding a portfolio of segregated assets and liabilities. Besides incorporating new funds, the VCC framework also allows fund managers to redomicile existing overseas investment funds by transferring their registrations to Singapore. VCCs are regarded as companies for tax purposes and are expected to file its estimated chargeable income, ECI, within 3 months from the end of the financial year, as well as Form C, its tax computation and financial statements. To qualify for tax residency in Singapore in a calendar year, the control and management of the VCC's business must be exercised in Singapore for that year. Key factors defining control and management include the location where the board of directors meet to make strategic decisions. As such, dividends paid by a VCC that is tax resident in Singapore will be exempt from tax in the hands of its shareholders. A VCC can also apply for a certificate of residence to support its claims for tax benefits under Singapore's avoidance of double taxation agreements with its treaty partners. VCCs are eligible for partial tax exemptions, start-up tax exemptions and corporate tax rebates, which will be computed at the VCC level. It is up to the umbrella VCC to allocate the exempt amounts and rebates between its sub-funds. For GST purposes, each sub-fund of an umbrella VCC is regarded as a separate person. This means that each sub-fund is required to assess its GST registration liability based on the value of its taxable supplies made, and file its own GST returns upon registration. Stamp duties, such as buyer's stamp duty, BSD, additional buyer's stamp duty, ABSD, seller's stamp duty, SSD, are levied at the sub-fund level. This means that if a non-umbrella VCC or a sub-fund executes dutiable instruments, such as contracts or agreements for sale of properties or share transfer instruments, stamp duties are payable within 14 days after the date of execution in Singapore or, if the instrument is executed overseas, within 30 days after the date of receipt of the instrument in Singapore. When considering the various fund structures in Singapore, such as a VCC, limited company, limited partnership, or unit trust, there may be limitations and tax implications for each of them when used as vehicles for investment funds. Consider consulting with a professional corporate, accounting and tax service provider like Corporate Services Singapore to help you plan, determine, and incorporate the right business entity.